Hi, welcome back. So you might remember that some weeks ago I made a video responding to certain claims that Richard Wolff had made with regards to the issue of monopoly and competition in capitalist societies. Now in that video I criticized various things, and the first thing that I criticized basically was the fact that he seemed to believe certain topics in neoclassical economics that are not accurate and that are not in line with what we see empirically. One of these things was the determinant of the degree of competition within an industry. Now he seems to be making the case in the videos that I showed in that video that I made in the past, and in the video that I'm going to speak about today, even though I'm not going to be able to play it because I cannot edit these videos yet. I still don't have my computer. And basically what I said there is that Richard Wolff seems to hold this position that the degree of competition within an industry is determined by the concentration ratio, by how much of the market share goes to a few firms. So if a lot of the market share is concentrated in one or two or three or four firms, this means, according to Richard Wolff's theory of competition, which he is actually taking I don't know where, but it seems that he's taken it from neoclassical economics, as I already explained in that video. If this is the case, then you expect that in industries that are more concentrated, that there's going to be less competition, right? So this is something that Marx himself did not believe, and this is something that I myself don't believe, and those that are in line with the approach of the classical economies of Marx with regards to the study of economics, we do not agree with this position because we accept the fact, and this is something that it's quite observable, that industries with a high concentration ratio can still be fairly competitive. So when we look at capitalism, we are not looking for perfect competition, and when we don't see it, we then suddenly say this is imperfect competition, this is a sign of monopoly and of oligopoly power. What we see is real competition and its outcomes, right? And we see that in industries that are concentrated, there can still be a fair degree of competition that can still give rise to the kind of outcomes that we observe, those that support, for example, the labor theory of Paley, right? The regulation of relative prices by relative unit labor costs via prices of production. We also see persistent unemployment, we see persistent trade imbalances between nations, and we see other patterns that are explained by this approach of real competition, but that are not explained by the approach of perfect and then imperfect competition. So Richard Wolff made this argument, and then he extended it to the point of prices, right? He tried to make the case that when there's less competition in an industry, because it's more concentrated, because there's only one firm or two or three or very small subset of firms within an industry, that they can now jack up the prices. And this is something that I already criticized in the video that I made in the past, because it's not empirically well supported. In fact, it doesn't have too much empirical validity. But today I want to comment about this same issue, but I want to be more direct, more concise in my explanation of this issue. And I also want to be a little bit more strong in my criticism, because recently Richard Wolff made a video responding to a Patreon question where he seemed to make these same cases that he had made in the past and that I had criticized, but he seemed to go a little bit more towards the extreme position of this monopoly capitalism, this leftist notion that capitalism now is dominated by monopolists that jack up their prices, that interfere with the functioning of the market, and so on and so forth, which are notions that are really rooted on this notion of perfect competition, as I already explained. And in this video he seemed to go more towards that position, so I want to be stronger in my criticism and make it clear that a proper Marxist approach to the understanding of economics should not be grounded on this notion of monopoly capitalism, but that should rather be focused on real competition and what the actual outcomes that we see empirically are. So in the video he is asked by a Patreon member the following question, something that goes like this. He says, why, if there are constant economies of scale and the bigger that your output gets, the more you reduce unit costs, are prices of consumer goods forever rising? And here we already have somewhat of a trick, because at first we're speaking about output within an industry, within a certain firm. We're talking about economies of scale, and we're talking about reducing unit costs. And then at the end of the question, we're speaking about consumer prices rising. So at the beginning, we seem to be speaking about the theory of relative prices. We seem to be speaking about what determines in reality, relative prices. And in the second part of the question, we're speaking about the price level, which are distinct theories already known since the time of Adam Smith, Ricardo, and certainly Marx, because there's one thing is to speak about relative prices and what are the determinants of relative prices. In the classical tradition, it is certainly the case that relative prices are determined via competition, via the equalization of profit rates between industries, that they are regulated by unit labor costs, although there is a certain factor of disturbance, as we've seen in other videos. But the main thing that determines relative prices is relative unit labor costs. So when we're speaking about the price level, we are speaking about a different thing, right? We're speaking about the consumer price index and its change. And the change in the consumer price index, if positive, is inflation. So we're speaking about the general level of prices within that economy, not about a specific set of relative prices. So Ricardo had a quantity theory of money for what determines, a classical quantity theory of money for what determines relative prices, and more modern approaches such as Friedman's approach to this issue seem to be that inflation, that what determines a positive change in the in the general price level is essentially a monetary phenomena. So there's a quantity of goods and services that are in an economy, and that if you increase the supply of money faster relative to the increase, or if you actually decrease the quantity of goods and services that are in that economy, that you're going to get inflation. And it is something that Marx already had a theory of inflation when money was backed by gold, and there are certain sketches of what might be a theory of inflation with fiat money that Anwar Shaikh develops into an actual theory that is quite accurate in my opinion. And it is certainly the case that with fiat money, the monetary phenomena starts to explain a lot of things regarding inflation. But Richard Wolff here is not really going to make this argument. He seems to be speaking about the price level, but the reasons that he's going to give for why the price level is rising, for why prices, he talks about consumer prices and the way in which we measure consumer prices in that economy. The general price level is the consumer, one of the most important, the most common measure is the consumer price index, and the change in this consumer price index is normally taken to be the measure of inflation or of deflation if it's negative or if it's positive. And he seems to be making the case, right, that prices are rising because of monopoly power. And this is something that I don't really get how you can get to this position, because it's clearly the case that the moment that money, that the currency that we now have, US dollars and in Great Britain pounds and so on, that the moment that they stopped being backed by gold and now countries started to print their own money and so on and so forth, that inflation suddenly became a common phenomenon, that it started to become a phenomenon. If you look at the data on this, I cannot show a graph, but you can look at this data yourself, that by the time that the gold standard ends, there's suddenly a spike in inflation, that it's going all the way. And now, central banks are the ones that try to control inflation within that economy by regulating the money supply. And this is basically what explains a lot of why the prices have been rising. The price level, right? The price level, why it has been rising. Because there's a distinction between real variables and nominal variables. Because nominal variables, if you look at relative prices in nominal terms, it might certainly seem that, one price is rising, because it's certainly the case that it's rising because of inflation. But if you look at it in relative terms, if two prices rise, it's a ratio, right? If two prices in that ratio rise at the same proportion, the ratio is still going to be the same. So we cannot really try to make a case for the general price level, if we don't have a proper understanding of what determines relative prices and so on and so forth. And basically Richard Wolff makes the following point. So in line with what he has said in the past, his argument is the following for why prices are rising. We don't know exactly what he means, but I take that he means the general price level. He goes into this rant that he normally makes about how competition makes it so that in an industry that had a lot of competitors, that had relatively small businesses competing with one another, that the ones that are able to produce at a lower cost are the ones that win in competition, and that if they are able to secure a big market share, that they now become the monopolists, and now they are in the position to jack up their prices, which is something that it's not empirically well supported. Now, it might certainly be the case that you can find one or two specific cases where this is the case, or you can actually speak about actual collusion, which is not something that we are speaking about. But in this case, might certainly be it might certainly happen one or two times, but in reality, this is not what we see in real competition, right? So we see that the profit margins, which is if you look at it in unit terms, is the price minus the cost. When there's more concentration, when the firm gets larger and it's able to produce at scale, that in the only case where empirically it tends to decrease is when the price stays normally about the same and the unit costs are reduced. So that is where we see, an increase of the profit margin, but that in general we don't really see this increase in the profit margin, precisely because we don't expect that prices will be higher in more concentrated industries. So Richard Wolff says this first, that competition makes it so that few businesses prevail in a determined market, and that they are able to secure enough market share so that they can then jack up their price, which is something that is not empirically well founded. And then he goes on and says that, well, there's counter tendencies, right? So there's new competitors that are trying to come in, reducing costs again, trying to sell at a lower price and so on. And that capitalism basically is in a constant struggle between more concentration, less concentration, by which, according to Richard Wolff's logic, we take more competition, less competition, higher prices, lower prices, higher prices, lower prices. But then he says, the reason why we have rising prices is because in this struggle, in more mature economies, like the ones we see in the first world, developed world, this actually tends to lean more towards monopoly. So since it tends to lean more towards monopoly, that's why we see rising prices. Now, first of all, even though he had said in the past that he doesn't support the notion of monopoly capitalism, now he's kind of accepting it, right? Because he's saying, well, there's this struggle, but in the end, the monopolists are the ones that win because I need to explain why prices rise. And the only reason why, according to my own logic, prices can rise in this consistent fashion is because monopoly consistently wins over competition. And this is entirely false. Not only is it false because we're speaking about different things when we are conflating relative prices and then and unit costs and then the general price level, because it's certainly the case that the general price level is rising, and a lot of it's due to monetary phenomena, not to a sort of class of monopolists that are making it so that prices are now generally higher and so on and so forth. And then second of all, it's not empirically accurate because it's not even the case that competition is determined by the degree of concentration in an industry, and that when there is more concentration, the profit margins are jacked up because the prices have been jacked up, right? So this is clearly an entirely false argument. There's no way you can possibly argue that this is correct in any sort of way. And it strikes me as odd because Richard Wolff, being a fairly established scholar in Marxist economics that I've learned a lot from, it strikes me that he would be making these arguments when they are not really consistent, where they are not really empirically accurate, and they contradict in some instances the very methodology that he seems to be using. He seems to be using Marx's methodology, but then he's now subreptitiously including neoclassical assumptions about competition, its determinants, about monopoly and about the profit margins and so on and so forth. So if you want to look at a discussion on the empirical data more in particular, I discussed it in the video that I did some weeks ago. And what I basically want to say today is, for those of you and of us that are interested in Marxist economics, that are interested in understanding capitalism from the standpoint of the classical economists and of Marx, the notion of perfect competition is completely wrong. We need to look at real competition. We need to look at what actually goes on in the real world, and not some imperfect or perfect notion of it. So it's very important to notice that in order for our hypotheses to actually become theories, which they have because they have been empirically validated, they are based, a lot of the things that we speak about are based on competition, are based on real competition. So if we see that the data is consistent with the labor theory of value, with the theory of persistent unemployment, with the theory of persistent rate imbalances, and so on and so forth, if this is the case, of the regulation of the equalization of incremental rates of return and so on and so forth, if this is the case, this is because we see competition, not perfect competition, not imperfect competition either, but real competition. So I would rather say that we move away from this notion of monopolistic capitalism, that we move away from this notion that it almost seems like a conspiracy theory, right? That monopolists are controlling capitalist societies, because in reality, for Marx, capitalists are themselves subject to the laws of competition, right? So if a capitalist wants to jack up prices above of what is the competitive price determined by the relative unit labor costs, then he's going to tend to get out of business, and this is an inescapable fact, right? So, and it can certainly be the case that momentarily there can be these distortions created by certain degree of monopoly power and so on, but it is not generally the case. So when we are trying to explain why prices are rising in capitalism, first of all, we need to understand what we're talking about, the price level, and about changes in the price level, which are determined by things different from the theory of relative prices, from what determines relative prices, although there's a connection, of course. And second of all, we need to understand that we are not in a monopolistic capitalism, that capitalists themselves are subject to the laws of competition, that there is no God that determines the outcomes that we see, that there is no... So it makes a good political case, right, to point at a specific person, at a specific set of people, those monopolists. It's not even that specific, because in the end it's really abstract, and then say that those are the ones that are causing all the issues that we see, the rising prices. Inflation, it's not caused by monopolists. That's certainly the case, and there doesn't seem to be a case that there's some industries that have consistently higher prices than the competitive level, especially because the competitive level in our theory is not determined by perfect competition. And I think it is important to move away from these notions, because in debates with other people, ocean economists or people that defend other schools, we can really make a fool of ourselves if we defend these notions, as I already played in my last video, where Richard Wolff tried to make this point against a person, and then he was challenged to empirically support his position, and he couldn't really support it. He talked about Walmart and Microsoft, and in reality he didn't really make a point there because there's no evidence. So this is part of what I want to ask Richard Wolff is, what is the evidence that supports your position? Where is the evidence that supports the argument that you laid out in your videos? And how can you reconcile this with Marx's own approach to competition, to relative prices, and to the general price level? How can you actually reconcile this? Because it seems like you are positing a new theory that is not based on the notions of the classical and of Marx's economic thinking, but that are based more on neoclassical assumptions that are unfounded. So with that being said, I'm going to end this video. I hope you enjoyed this content, that you think profoundly about these issues, and that you move away from these notions that are anti-scientific in some cases, and that do not really reflect the general spirit that we should use in our approach to economic theory and to the understanding of capitalism. So with that being said, I'm going to end it here, and I will see you in the next video.